Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast, I titled Trump Administration, The Truth About Central Bank Policy, U.S. in Crisis, and China. And we're actually going to talk about a lot more. So we have a lot to cover, and we have a wonderful guest who has spoken at my family office association before and has really become quite the global rock star. It's excited to have him on, and that would be Larry McDonald, economist, political risk expert, New York Times best-selling author, and his book is great, and founder of the Bear Traps Report. Larry, welcome to the show.
Angelo, thank you. It's great to be with you.
Well, thank you. It's great to see you again, at least if not in person, at least on video. And I'm certainly a big fan of your work over the 11 or so years that I've known you, and I loved your book, and your Bear Traps Report is utterly fantastic. Well, actually, because I got my issue this morning, a little bit later in the podcast, we'll jump on a couple of points that came up there. But why don't we just jump right into it? Because I think the geopolitical perspective and how it plays out politically and with the economy and finances is going to be critical to a lot of our live listeners and our audience today. So let's just jump right into it. Here we are. I guess we didn't see this coming. COVID-19 comes along, although it may not quite fit the definition. Let's call it kind of at least a black swan event. And really it's been, I've never seen this in my lifetime, something that is so impactful to the world. So where that leaves us now is kind of economy and small businesses here in the US and around the world in shambles. And I did emphasize small businesses. My opinion, New York City, where it's getting it the worst, it's really sad. I can't imagine not that 25 to 40% of the small businesses just aren't going to make it. They aren't going to be able to come back. Restaurants and others that don't have a lot of capital. There's a variety of reasons, rent issues, how people are going to want to be in congestion with others, all these factors. Now, what makes it also complicated is we're in an election year here in the US. And what I led with the Trump administration is there's actually things that are going on that are probably not classically Republican. I could argue some of it a little nationalistic. Now, of course, we don't want to have people have no food and go crazy in the streets, and that'd be very sad. But we have an incredibly growing deficit. We probably at the moment have no answer for it. So I'm building up quite a doomsday. Hopefully you could take us out of that doomsday. But why don't we just jump right into it? What are you seeing and how are you thinking this is going to play out politically?
Well, in our Bloomberg chat, so picture with the Bear Traps Report, we have a Bloomberg chat with about 500 buy-side institutions around the world. And the nice thing about it is we have about 50 contributors. So on a daily basis, we're running the chat right now. We're getting contributions from real on-the-ground asset managers, hedge funds, pension funds, RIAs, family offices all around the world. So we're getting a good cross-section of feedback on our trends and also trends that we're seeing in the market. In other words, views that we have, high conviction calls, but also we're getting phenomenal feedback from clients around the world as to what they're seeing. And the biggest thing going on right now today, Trump and Mnuchin desperately want a weaker dollar. Behind the scenes, the Treasury and the Fed have done a number of things that are very powerful in terms of weakening the dollar, swap lines, very supportive of the global economy. And a big thesis that we have laying out here has been since obviously March, because that was the best buying opportunity, is we feel that commodities will dramatically outperform U.S. equities. And it's not just commodities sector equities as a whole, commodities, raw commodities, as well as commodity sector equities. And the reason is that the dollar is the key. You just had all these central banks and governments to 15 trillion of stimulus, and that's fiscal and monetary. And the last thing in the world they want to have happen is a 2016 or 2020 early on January. They don't want a strong runaway dollar to destroy all the work that they've just done. So behind the scenes, there's a number of things going on they've done to really weaken the dollar. And clients in the chat have been constantly pointing out, the U.S. went into this. It's the opposite of '08. In 2008, as I wrote about in our book, it's a New York Times bestseller. It's now published in 12 languages. But there was the U.S. led the world into that recession and then was first out. So first in, first out. Now the U.S. came into this for a number of reasons last, and some are political. You can blame the Trump administration, or you can just look at Asia. Asia went in first, and a lot of countries like the U.S. weren't as fast to respond. Europe went in second, and now the U.S. is really the last major economy in the world to go in. So what we're seeing is a rebalancing of the global economy. You're seeing participants around the world, G10 countries, especially in Asia and in China, and coming back in terms of leading the world in terms of a bounce. The U.S. is bouncing, but not as much as the rest of the world. So the dollar has broken very, very key levels here, and that's very supportive of the commodity complex as a whole.
Yeah, we're going to get a little bit to asset classes a little bit later, and you and certainly others have been very bullish, I would say. And really from your perspective, because you have so many amazing allocators and talented managers, it basically is a lot of what you're hearing with your ear to the grindstone, and certainly what our family offices are picking up as well. Do you think Trump will beat Biden this November?
Right now, he would win, I think, in a big way. I think November depends on. I think he would win right now. We just need to have that economy. The U.S. economy has to keep rolling, not deteriorating too much. Unfortunately, we were into this red state, blue state thing in the United States, which Trump is pinning on. For a number of reasons, the blue states are slower to open. They're bigger economies like New York and Illinois and the like are much more exposed to the global problem. In other words, the red states don't have 3 airports with 1 million people a month. Well, probably several million people a month coming in and out of New York. So you're talking about a red state, blue state dynamic. So Trump is pinning this problem on in terms of reopening. You have church, perfect example. This does not play well for the Democrats. Churches in many states are banned services, but you have Home Depot, record profits, stocks at an all-time high today, and you have this like dynamic where certain things are open, certain are not, and the Democrats, Trump is trying to pin that down on them. Right now, that's working. Who knows how long it's going to work for?
And I mean, how about the issue of, I guess, like you said, Mnuchin and Trump and the administration is pumping money into these stimulus packages. And I'm not saying that part of it is not needed. I mean, again, you can't have people just that they can't buy food and going crazy. I get it. But it's very frustrating when you're looking at a deficit grow and you don't really have what's going to be a way out of it? I guess super low interest rates and incredible economic growth that could help to override that in the years to come. But is it inevitable that we're going to have inflation and higher taxes in the U.S.?
Absolutely. This is the problem for the next couple of years for tech, is the inequality. So the largest 100 companies in America are now about 76% of profits. So the largest 100 companies in the United States are about 76% of total profits. And when I was coming up in the business in the 80s, that number was in the low 60s to high 50s. And in the 70s and 1960s, that number was probably in the 40s or 50s. So the largest 100 companies used to have 55 to 60% of the profits. Now it's close to 80% of the profits. And so both Democrats and Republicans, but mainly Democrats, Democrats control the House. Right now, the probability of the Democrats taking the Senate has risen dramatically. So that's another piece of risk for tech. The probability of the Democrats taking the Senate is up sharply the last 6 weeks. So those big tech stocks are an absolute piñata. They're going to come at them with, I think they're going to tax the top line next year or the year after. And so you won't be able to pull an Amazon where, for several years, in recent years, Amazon really didn't have any profits that were taxed. They were reinvesting a lot of their profits into incredible CapEx and venture capital expenditures. But on the problem is, I think the next stage, both in Europe and the United States, they're going to start taxing the top line. So taxing revenues.
Yeah, I mean, for companies like that, that's probably, I mean, they may be expecting it because depending on how it plays out politically. But yeah, certainly it's an interesting issue. We're going to circle back to that because it relates to the other core topics we're going to talk about. But let's jump a little bit into, I think, one of your terminologies. Maybe I read it in a Bear Traps report, and basically it's the truth about central bank policy. Well, Larry, tell us the truth about central bank policy.
Well, once again, the problem is it's fueling inequality. So right now, the 30-year mortgage is the same level as it was in 2012. So the 30-year mortgage, same level as it was in 2012, but the 10-year bond, for example, and the 30-year bond, the 10-year is 100 basis points lower. So the Fed's done a number of things to try to help the economy. But right now, as of today, we're now at $1 trillion of corporate debt issuance.
Mm-hmm.
The gap between the winners and that number is up dramatically from the last couple of years. You're talking about a 2 standard deviation move higher than the last 4-year mean in terms of corporate bond issuance. 1 trillion so far this year. And so the spread between the haves and the have-nots in corporate America is rising dramatically. Some companies like United Airlines are shut out, and other companies that, the Netflix of the world, some of the FANG stocks have very, very easy access to capital.
And so we're talking about U.S. central bank policy, but really you look at what's going on around the world in Europe and Asia and other parts of the world. I mean, how are we actually comparing, not necessarily in combating the COVID-19, but that plays a little bit into it. But am I making things out to be a little worse than they really are when we compare ourselves, the U.S., to other developed countries around the world?
Well, the Fed, if you look at the Fed's, the entire package of responses that they have, like the tools in the toolbox, they have a lot more ammunition that's not being used, by the way. Some of the, they really haven't bought much in terms of corporate bonds, in terms of small business lending facility that's coming online next week. So a lot of the Fed's firepower hasn't been deployed yet. Whereas if you look at the ECB, for example, this PEPP, this QE program that's going to buy, in the last several years, there's been kind of a unwritten rule around what's called the capital key. So in terms of GDP versus how many bonds the ECB can buy. And there was a hard, a hard unwritten rule there. That's been thrown out. So the ECB has to become more aggressive because you've got countries like Italy that their debt to GDP is exploding. They've been under a heavy lockdown. They were already in recession going into this. So the ECB is dramatically expanding those purchases. But in terms of the overall creative package that the Fed has versus the ECB, both fiscal and monetary, it's I think the U.S. is probably close to $2 trillion ahead in terms of firepower right now. Now, this big thing that happened in the last couple of weeks, and this is probably one of the most important parts of this call, this German-Franco alliance around a new facility that will, it's almost like a transfer system where Germany and the wealthier countries will make transfer payments to the South and issue debt from a new facility. And so this is a big negative for the dollar if they can pull this off. It still has to get through through obviously all the different governments in Europe in terms of approval. But it's a big change, and that's another huge reason why the dollar is weaker, euro is stronger, is that 2-3 weeks ago, say 3 weeks ago, 4 weeks ago, the expectations in the market and the bearishness around the European banks, the bearishness around the European economy relative to the US was extremely high. So this caught the entire asset management community off balance. And so, you know, a number of clients in our live Bloomberg chat, our Bear Traps Bloomberg chat, have been pointing out that the ECB accelerated this dynamic, this new tool. It's not just I'm sorry, it's not really the ECB, but it's the governments of Germany and France. This was accelerated because of the we believe because of the German Constitutional Court decision. Now that's coming up. That's about 60 days away, where the German Constitutional Court can kind of put some handcuffs on the ECB around bond purchases potentially. It is a big problem if we come to that. But in the meantime, this new facility is a dramatic game changer, because think about the world, right? If you're a billionaire, millionaire, where are you going to put cash? Treasuries are the most liquid. Japanese bonds second. They're in Europe. There really aren't a lot of bonds to buy. But if you have a AAA rated bond that's backed by the European Commission, that's going to start off with a $500 billion to $700 billion facility, we know how this works, right? When these new debt facilities start at, say, $700 billion, in 5 or 6 or 7 years, it's going to be a several $1 trillion facility. Okay, let's not kid ourselves, right? Like we don't have when governments start spending money, in one area, they don't typically stop. So for the first time, people are looking at the global landscape, and you look at it over the next year, and the U.S. dollar is going to have a lot of competition. So it's a very, very bearish scenario, I think, coming at us for the dollar, and that's starting to manifest itself in this incredible rotation over the last 10, 15 days in markets in terms of commodities and value stocks.
I mean, with the bad news on COVID, with small businesses getting crushed, with the world kind of on shutdown, yet shockingly, since March 23rd, the stock market, and maybe that's the stimulus package and hope, it's great for President Trump, of course, because the better the economy looks, the more likely people are to be in a better mood, so to speak, and vote for him. But the stock market, is it a complete bubble? Is it artificial how it's propped up? Or why is this different than other crises before?
Well, what happens is, and we saw this in February, remember, everybody forgets, but the Fed, between September and February, the Fed expanded their balance sheet by $400 billion. Okay, $400 billion, 375 to 400 billion. So the mantra in February was, don't fight the Fed. Don't fight the Fed. The New York Fed model, a lot of people look at, and that's your raw cash flow yield in equities relative to the 30-year bond. So if you look at just the raw cash flow yield from stocks versus the yield in the 30-year bond, you can come up with these kind of comparative valuations that make stocks look cheap in a world where the Fed's expanding the balance sheet, providing lots of liquidity. One problem that we've seen over this week with tech stocks is, think of like the free cash flow, the net present value of cash flows in NASDAQ company stocks. In a very deep deflationary world, that cash flow is worth a lot of money. Case in point, a company like Netflix. They can borrow money in the public markets at extremely low levels, and then just go out and make incredible content that they can monetize for the next 20, 30 years. I mean, for Christ's sakes, the Seinfeld portfolio is still generating, hundreds of millions of dollars in cash flows and profits. So when you have a free amount of capital to create content, the valuation on these stocks in the marketplace, you can make the case for 40 to 50 times earnings. You can make the case. The problem is, and that's in a deep deflationary environment with an aggressive central bank. The problem with this thesis is, if you go from deep deflation expectations to just deflation expectations or mild deflation. All of a sudden, your 40 to 50 times earnings that people are willing to pay for NASDAQ stocks goes from, say, 25 to 35 times earnings. So you don't need inflation to destroy the NASDAQ. You just need deflation expectations to normalize to just mild deflation to moderate deflation. And with a central bank that's aggressive, I think that's what we've seen over the last week is that the Fed was very aggressive in March and more so April, but now they're doing a slight tapering relative to in terms of what they were buying a month ago. So right now what's going on is the Fed is tapering relative to what they were buying a month ago. At the same time, inflation expectations have risen, deflationary expectations have collapsed, and that's starting to put pressure on the NVIDIAs of the world. Some of these stocks are off 15% in like 3 or 4 days as inflation expectations have risen.
And I mean, a big difference, I guess, between 2007 and 8, the last big crisis, and now, it seems like back then, like everything correlated to one and went down. There are definitely winners. Those that are not going down as much are actually being very profitable in this unique time in market. It's been really, really intriguing. Even looking at public equities, and you mentioned one in Netflix and Zoom and Walmart and Amazon, you would think those are likely going to be good bets moving forward. But if what happens to top line taxes and revenue that you said to tech companies, that may change that dynamic a little bit.
Absolutely. I mean, the FANGs are, I think, in a really bad spot over the next 2 years. And don't get me wrong, we were really bullish and we were a little early. We were pounding the table in March. Our partners in Washington, we work very closely with ACG Analytics in Washington. We typically, in a typical year, we'll take clients around the Hill. We'll work with the Treasury Department, Commerce Department, educating institutional clients on what's really happening around the Hill. And once again, the key to managing money since Lehman is buying capitulation, selling the relief rally, but getting in front of the policy response. And what we've seen over and over again, 2016, remember, the market was in flames, commodities were in flames. Janet Yellen promised the world 15 rate hikes. And next thing you know, in 2015 and 2016, they hiked rates twice. Once again, the policy response there, the Fed didn't do trillions of dollars of QE, but they did take massive rate hike expectations from, say, 14 rate hikes down to 2. That dramatically helped the commodity complex, the global picture, weaken the dollar, and that's kind of what we're seeing today. Once again, you have to buy capitulation ahead of the policy response. It's worked consistently since 2015.
And getting back a little bit to currently what's going on with the economy, the stimulus and central bank policy. And yeah, I mean, as you painted, it sounds like a pretty potentially could be a rough and ugly picture for the US. But I go back to, isn't it like that for basically all of us? Could I make the argument for the US, besides some of the dry powder that you noted that hasn't been utilized yet, that could be of help? I mean, this is still the United States. We have great territory and people. We have friendly neighbors. We have protection with oceans on each side. We have a great military. We have a wonderful agriculture system. Let's not talk about logistics. That could probably use some work and some of the infrastructure. I get it. And entrepreneurship and venture capital is completely dominated by the US. So I know it's going to be, you're going to look at what you're hearing and say negative, negative, negative. But again, relative to others, how could you paint potentially a little bit more of how this could play out well for us as a country?
Well, it's not that I agree with Buffett, never bet against the United States. He said that again at Berkshire last month. But I guess our point is, think about the last 3-4 years. We had the Brexit crisis. We had a trade war, and now we've had COVID. All of those things, those 3 dynamics, have driven assets into the United States, into dollars, right? Everybody's hiding out in tech. Everybody's hiding out in treasuries. Think about this. In tech stocks and treasuries, you're talking like $25 trillion
Yeah.
that's hiding out in those two spots. So UK equities, for example, like the EWU ETF, we brought clients over there in the fall, in September, with ACG Analytics. We met with the Liberal Democrats, met with Corbyn's people, and we met with Farage's people. So we met with all the parties. And I just think the risk reward, right now, the United States equities, for example, the S&P's just above its 200-day moving average. UK equities are trading at 5 or 6 handles cheaper in terms of valuation than the S&P. Well, literally light years away from the 200-day moving average. So just in terms of valuation and risk reward, you have a much better risk reward in some of these global stocks, because at the end of the day, 3 years, Brexit, trade war, COVID has driven so much capital into the United States. Now we're coming into a period where the big tech stocks are probably going to have targets on their back in the United States. Have a weaker dollar regime, I think, quite obviously, and that's going to take capital just from the United States and spread it around the world a little bit. So that valuation gap, right now we're trading enterprise value to EBITDA in the United States, the highest level ever in terms of valuation. You'll see money move into value stocks globally, and that's very supportive of UK equities.
And I guess a big question, without really much build up into it, what are you hearing and what are you thinking, and how the interplay will be with China?
Okay, give me 1 second. A little water.
Building up a little anticipation, everyone.
Yeah. So I'll give you a great risk indicator. So we have our 21 Lehman our index of our 21 Lehman systemic risk indicators. And we developed it around the time of the crisis. There was a group of people at Lehman that were trying to stop the madness, and one by one, they were silenced. I mean, I reported right up to Mike Gelban. Mike's a very dear friend of mine. He founded Exodus Point, the largest hedge fund launch in the history of hedge funds. It's now, $8 billion fund. And this was like one of the good guys at Lehman. There were a lot of incredibly smart people that I worked with. And over the years, we've created this index of our 21 Lehman systemic risk indicators, and they were very helpful in February. I was quoted in the Financial Times around February 17th, talking about we expected a large Lehman-like drawdown in the very near term. And so right now, in terms of those indicators, there's a lot of things that are really good in terms of liquidity, FRA OIS, in other words, bank lending, interbank lending, the cost of interbank lending in the United States, for example. A lot of the liquidity in the repo market has improved dramatically. But the couple of things that are really standing out as problems is, if you look at the VIX relative to the implied volatility on the yuan in China. So hedge funds around the world are betting on a weaker yuan in size. So like the implied vol on the yuan, CNH vol, is rising sharply. And if you look back the last 5-6 years, every time, and what we do is we measure the speed of the rise, right? It's not just looking at the yuan. You can look at the CNH, CNY, onshore, offshore, in terms of the China currency. But China has tons of trading partners around the world. So when their currency is devaluing, it's very unsettling for risk. And so President Xi knows Trump is heading toward an election. We have a House and Senate. We have a Democratic Party that I think knows that Trump has tried to outflank them on China, so they have to play catch up. Mm-hmm. They've just had a couple of years of China, Trump playing hardball with China. And so Democrats and Republicans are both trying to show a tough face on China. At the same time, President Xi is really poking Trump right now. I mean, he's letting that currency weaken at a very, very fast rate. Strong devaluation. So right now, like especially over in the next couple of weeks, with equities here in terms of short-term risk reward, when volatility on the yuan is rising at these levels, and the VIX, it's basically a leading indicator in terms of volatility. Going back to very, very incredibly predictive leading indicator in 2015, 2016, and last year worked dramatically. So right now we're seeing that implied vol on the yuan rise, and it's typically at the speed it is. It's basically telling you right now the risk reward in U.S. equities or industrials is poor for the next, say, 3-4 weeks.
And let's change directions a little bit. It will be intriguing for our audience. They're going to want to hear what you're hearing and then your opinion, kind of putting it all together. So in allocating assets as a significant family, a family office, what do you look at as being opportunistic and being tactical in this market? Or what are you hearing, whether it's country specific, specific asset class? And again, there's definitely opportunities. What do you believe? Where should significant families with liquidity and time on their side, should they be spending more of their focus investing in?
Well, as George Soros has always said, the best capital gains are found by discounting the obvious and placing capital in the direction of the unexpected. So to me, you have commodity prices at multi-year lows. I mean, you've had a rally for the last 2 weeks. Soft commodities have dramatically underperformed hard. So your silvers, your golds, your coppers have really moved the last 4 weeks, 5 weeks. We love silver here. If you look back to 2015, more toward 2008 to 2011, the last time the Fed was really doing what's called MMT, modern monetary theory. The Fed would never admit it, but if you look back then, the tax revenues in the United States relative to the QE program, the Fed was doing MMT. It's the same thing now, where in the United States, they push back we push back the tax deadline. So people that were supposed to pay their taxes on April 15th now have to pay taxes on July 15th. So you have a Fed that's expanding the balance sheet relative to tax revenue at a trillion-dollar, multi-trillion-dollar pace. So you want to be long in that environment assets. And if you look at silver relative to gold in that environment, 2008 to 2011, silver dramatically outperformed gold by over 150 basis points. So did copper, by the way. So a lot of people are in gold, but we think that you get a better return in some of the hard space in silver. In the softs, stocks like Mosaic are trading at the cheapest level in years. This company makes a potash producer. So in the soft commodities, we've seen a rise here in the last couple of weeks. But think about this. Here's the big picture. Once again, $25 trillion is in bonds and big tech. That's a lot of money just hiding out in technology stocks in the United States, bonds. So the slightest whiff of any type of inflation expectation normalization, that pool of capital has to have a hedge. And so what happens is when there's that much money in those big deflationary bets, and that's what they are. I mean, there's the two biggest deflationary bets on the planet Earth are U.S. Treasuries, which will do incredibly well in a deflationary environment, and tech stocks. So when there's that amount of capital in there, and that's where the entire mad mob is, we think you want to go the other way. So the first step would be commodity asset managers, commodity producing equities. And the second would be, I think this is very important, David Einhorn's Greenlight Capital. I mean, this is a screaming buy of a hedge fund because once again, your value-based managers, your long-short equity managers in the value space are in a bear market because because everything we're talking about here, right? Your long-short managers, like your Einhorns of the world, have been in a bear market underperforming because the deflation trades, your FANG stocks, your big tech, your treasuries, have been the place to be. So as money, if 5% of the money of that 25 trillion that's in tech stocks and treasuries moves into other areas, your value names, your value managers like David Einhorn, Greenlight Capital, they are going to massively outperform. Stan Druckenmiller, and this is very important. I love Stan. I talked to Stan maybe 3 weeks ago on the phone. He did a beautiful piece at the New York at the New York. It was in New York. It was basically a podcast like this, and I forget the name of the organization, but his main point there was that he says we're coming into a bull market for long short equity managers. And the reason he said that is because over the next 5 years, he thinks equities are going to be flat because of the rising tax dynamic. And there's going to be tremendous winners, tremendous losers. We're already seeing this in the capital markets in terms of that $1 trillion of corporate debt issuance. For the spread between the haves and the have-nots in corporate America has never been larger. So your long short equity managers in the value space will be the place to be. High conviction screaming buy call in terms of my humble opinion.
Yeah, I mean, it's been a long time since long short hedge fund managers have really been able to have a chance to be superior. This might be that kind of market. So from your perspective, perhaps on the rise, commodities, and potentially the right quote unquote managers from a long short equity perspective, when you're putting extra money into something, that also means you're taking money out of something to put it into. What are you peeling back from? And you probably already mentioned it relative potentially to treasuries and corporate bonds, but I want to hear your opinion more thoughtfully.
Sure. So, well, the sectors that are the most expensive, the semiconductors here are screaming sell, big tech, screaming sell, software, all these names just have too many investors chasing performance. In the corporate bond space, in the United States, you think of U.S. high yield. You've got a Fed backstop with potentially there in terms of the Fed is going to buy ETFs. But remember, the Fed has come out and said, and this is very important, that they will buy ETFs to protect. So your HYG, your J&K, that's your junk bond, and then you have your investment grade ETFs. So the thing that we are hearing behind the scenes, the Fed really will deploy that weapon at a much lower place in the market. So the Fed, just with words, has been able to support the market. Financial conditions have dramatically improved to the point where, like we just talked about, we've had $1 trillion of investment of corporate bond issuance already this year, and that's 2 standard deviations higher than any year in the previous 7 years. So the point is that your investment grade bonds here and your high yield bonds in the United States, I'd be a screaming seller because we truly believe that the Fed talked those markets up beautifully, opened up the capital markets, but they really aren't going to deploy their weapons until I think with conviction, I strongly feel that they'll let the market kind of settle here a little bit and say 2,200 to 2,500 on the S&P. I think that's where they may deploy some of these weapons in the U.S. corporate bond market. So the other important thing, the J.P. Morgan local currency bond ETF, I think is a real buy here because in a weaker dollar environment over the next 2 years, a diversified portfolio of local currency bonds is going to dramatically outperform. And this is a sector that has underperformed dramatically because of the strong dollar. And so those are some areas in the fixed income market that I'd be kind of like weighing into and then getting out of. And the last most important, I think, call is commodity producing countries. So Chile is an A-rated country with much stronger balance sheet relative to, think of like the have and have-nots. Chile versus Turkey and South Africa. I mean, you're talking about an incredible divergence now of have and have-nots. And so you want to be long commodity producing countries like Chile and Brazil, which are very, very cheap relative to the US. But once again, in a commodity regime, looking out of the next couple of years where the performance of commodities normalize relative to the big tech sandbox, those countries and emerging markets that have exposure, we feel will dramatically outperform. So the ECH ETF is Chile, and then EWZ is Brazil.
Larry, how will gold perform?
Well, gold's going to do just fine. It's just going to underperform your coppers and your silvers of the world. But once again, when the Fed has taken the balance sheet up by 3 trillion since last year. So right now we're at 7 trillion. And if you do the math, the amount of bonds that they have to sell at Treasury, so the Treasury Department, we think is going to start to issue more on the long end. So for the first time right today, you're looking at your 2s30s yield. So your 2s30s is steepening at one of the fastest paces in recent years. And so you have a steepening yield curve, but your real yields are depressed because the Fed is holding down that front end, holding it down, holding it down, holding it down. Inflation expectations are rising. So the yield on 30-year paper is rising. That's an incredible environment for gold. And so as long as the Fed's holding down the front end and inflation expectations are creeping higher, your real yields are lower, and gold in that environment could have, I think not easily, but could have a $2,000 price written all over it.
What we're hearing also from families that, again, they're not GPs that have to worry about LPs. They're families that have the wealth and have the liquidity and believe in sometimes good things take time. So that's presenting itself now in distressed opportunities. Could be real estate, could be private companies, probably a little less so the public markets. What do you think, or what are you hearing in terms of now is a time? I mean, could I make the argument? It's a bit of a stretch. New York, lots of people in a small area, great mass transit, lots of tourists, horrific things because of COVID-19. Is this going to be for the first time in a long time? Because New York is going to take, I think, years, to be honest with you. Even if we get a vaccine late in the year, possible. I just think it's going to be a while. Is it actually a chance to buy New York a little bit on the low side, as opposed to always buying at the peak? Just like New York was horrific in the 70s and most of the 80s, but then it bounced back unbelievably in the 90s. Might the good, now going bad, become good again, and you buy at a distressed opportunity?
Yes, but the problem is the Fed's not allowing the business cycle to function.
Yeah.
So a normal cycle right now, New York would be in flames. There are some parts that are really becoming distressed. You're absolutely right. But there's a lot of assets that are mispriced because of the amount of liquidity that's come in. So I think absolutely, but you got to just wait a little bit. I see a big default in New York. I mean, keep in mind, New York's budget, these numbers are mind-boggling. New York's budget before COVID was scheduled to come in at 92 billion. Chicago is like 10 billion, or maybe between 8 and 10 billion. Boston and Dallas are anywhere between 3 to 4 billion. So your New York budget was so mispriced relative to all the other big cities in the United States. And the problem is, as you just described, buying habits are going to really change. Like, people won't be going to Broadway shows and flying into New York in large scale for another 2-3 years. So you're going to have a big default in New York, and it's going to present a phenomenal buying opportunity sometime in the next 18 months to 2 years. I have friends that bought property downtown. We have a number of clients that bought property downtown after 9/11. A $1 or $2 million property bought downtown in like the year after 9/11. It's like literally a 4-bagger. So your nose is in the right place, but the Fed has distorted they're not allowing business cycles to function, so that the distressed market isn't cleansing fast enough for the opportunities.
That is true. It's not yet I think it'll be sooner than 18 months, but you're effectively correct. It's going to take a little more. It's a logical play on the surface for families with liquidity and time on their side. And is it something that's going to turn around and make a great profit a year or two after? No, it may even take 5 or 7 years, but I'm pretty confident New York is just not going to disappear from our world, and it will come back and just be a little different, but it's going to be very, very resilient. Perhaps you answered it already with commodities and gold, and that would be a fair answer, but I'm going to ask it maybe a little differently. For a family that's looking to hedge their portfolio, what would be deemed to be good hedges besides being diversified, which could potentially dampen returns, but arguably potentially be good against risk? And okay, commodities and gold. Anything else?
Well, vol is rich. I mean, what's crazy here is the S&P has rallied to above, 3,000, almost 50 today, 3,050. So we're getting up near the highs, and the 2-month VIX future is still more expensive than the 8-month. That's just insane. So people are paying more for that 2-month VIX future than they are for the 8-month. So that tells you that people want edges. I mean, it's absolutely crazy. It's like portfolio managers all around the world are trying to protect their gains, right? So for hedges, in terms of risk off, NASDAQ vol is probably the best bet. I mean, you want to be long a put spread on the NASDAQ. I mean, you don't have to get long the VIX. Remember, there's going to be the big winners and losers here. The S&P right now is being massively supported by the weaker dollar, this rotation into materials and commodities. Mm-hmm. So the S&P should be rolling over hard, but it's not, because the dollar, which is the global wrecking ball, that Bloomberg dollar index at 13, it broke 1340 this week, which was a huge support level. I'm talking like multi-month support level. It's broken. So that's really supported the S&P. So instead of getting long the VIX, I think you want to be long NASDAQ vol itself. NASDAQ, you can buy that in the futures market. And then look around the world at the other rich markets. There are some really, really expensive emerging markets relative to, the probability of a Turkey default is rising dramatically. So if you have a good asset manager, long, short, emerging market manager, I think it would be a great hedge right now, because that type of manager can get long EM countries that are going to benefit from this new cycle, but also get short countries that are just well on their way to default.
I mean, it's a little bit unfair to ask you, but of course I will anyway, given that you know so many of the world's greatest allocators and investors, and they're not going to be short of an opinion. They also have money and connections and may have some insight. What is generally the belief on how we may be trending towards effectively what would put, in theory, COVID-19 to bed? And that's going to be a vaccine. We may be on the cusp of some multi-drugs used together as treatments that will, for sure, that will be great. But a vaccine is really going to make it feel like it's behind us until the next pandemic. We'll worry about that at a future time, of course. Are you generally seeing the belief among these smart, intelligent investors that probably this fall or winter, or do a lot of them think it's going to really segue into, midway through next year, if not longer?
Well, the equity market's a perfect barometer of that, because there's no question that, there's a number of reports that have come out and clients are sending around these reports. But if you look at all the vaccine probabilities in terms of the amount of drugs, the amount of different treatments, it's like the AIDS dynamic in the 80s. If you remember, there was a couple of drugs, and then there was 5, then there was 20. The next thing you know, AIDS was surrounded by 1,000 plus medicines, 1,000. And so sooner or later, guys like Magic Johnson were able to survive and thrive through what originally appeared was a very, very deadly dynamic. And that's all just the multiplier effect of the medical global community surrounding a crisis. And that's happening here again on steroids. So,
yeah, like 100 times that.
Yeah, and everybody, talks about the 1957 crisis with the Asian flu, and obviously Spanish flu in the early, 1900s. but in those cases, they just didn't have this incredible global attack. Uh, so the probability of getting a vaccine is rising dramatically. There should still be a bump in the road in the third, fourth quarter, because number one, it's just getting it out and getting it out to enough hands and getting it into the market is still going to take even, historically, the fastest, just listen to Bill Gates, the fastest period of time you've ever been able to do that is like 2 to 2.5 years. Maybe they do it to a year, because the problem is you can have great medicines and great vaccines, but there's still a lot of downside to wide distribution. So
Yeah.
So that bottom line means, and this is so important for this presentation call. At the very end of the day, the only way to get through this, if you look at Massachusetts, 61% of the fatalities have been nursing homes or people that are associated with nursing homes, and 61%. And in Italy, you're talking about 90% plus. In some states like Pennsylvania, the amount of people over 100 that have died of COVID are more plentiful than the amount of people that are below 40 that have died by 2 or 3 factors. The amount of people over 95 that have died of COVID in Pennsylvania are relative to the amount of people that have died below 40. So you've just got this wacky dynamic where we're going to go back to work, but if you're a high risk person, you're going to have to make these nursing homes. The death rate in the United States is 100,000 today. Without nursing homes and without your people with high, like I'm an asthmatic, right? I'm a perfect example. I'm in trouble. I'm not going to be able to really get into New York and spend a lot of time with an asthma condition. So if you're preconditioned, like people like myself with asthma that I've had since I was a child, or elderly people, those people have to be isolated. So you're going to have a dynamic where the cities, ball games, sports, everything's going to have less participants, restaurants for the next 3 years, because even with the vaccine, you're going to have it's the amount of time to get it into the market, and you're going to have this dual society where we really protect those people in nursing homes, and we also isolate people with pre-existing conditions. But the people, I have literally 12 different clients that are less than 40 that have survived COVID. I don't know personally anybody that's died, and but I do know 12 people that have had it, and they have not, and they're like under 45, and to them it was just like a really bad flu. I've talked to every one of them. It was like a really bad flu, and so that's what we're up against is really separating the society, restaurants, Broadway shows, and the market will come back in terms of participation, but just less so. It'll probably take 2-3 years to get back to normal.
It's a related question, and no comment or opinion is fine. Tomorrow at 12 noon, I have on my podcast officials from the WHO and the UN. Obviously, there's politics, there's bifurcation. You can make arguments either way. I'll try to be nice. We'll see. I think I will be. I'm happy to have them on. But again, in general, from a combination of your opinion and what you're hearing, have these been well-meaning but disappointing organizations in this crisis? Or maybe we're being a little bit too negative here in the US about some of the comments we're hearing and the world feels differently. What are you hearing?
Well, as we head toward the election, there's just going to be more. I mean, you've got Trump, Republicans, a number of senators have picked up this torch. So they're just pounding home this message. We really can't validate the truth. That's the problem around the Wuhan virus, the origination. But the message is going to be clear. A couple of points they make seem pretty obvious to be true, and that is that China was containing the virus within China a lot more aggressively than they were in terms of controlling flights out of China.
For sure.
That definitely had a hand in Italy and in Europe, the devastation there. So, the WHO, there's going to be like a political landscape that's going to be very negative, and then there's more of a reality. So the public perception will probably grow more negative because it's just going to be such an election football that's thrown around, and the communication and the intimacy between President Xi and the head of the head of the WHO, it doesn't seem like it's on par and as fair to most Americans. And both Democrats and Republicans in the House and Senate are growing more hostile to China, and so it's just in terms of politicians in the United States, it's a no-brainer to take kind of a anti-China view right now. So I see that just picking up steam.
Makes sense. I mean, I could see how people could feel that way relative to the sentiment that you're noting. Well, we're basically there at the home stretch. For people that would like to learn more about you, and I'm assuming potentially subscribe and learn more about Bear Traps, explain what Bear Traps is and potentially how they could be involved.
Well, I started off in the business as a financial advisor, and I worked my way up I ran our distress business at Lehman. I was the most profitable trader for 3 out of 4 years in our group of different traders. And so I'm a very good trader from a distress point of view. My problem with research is in the world, there are very few people that are in the research business that have actually been in a risk seat.
Yeah, exactly.
It's unbelievable. And Steve Jobs always said, unless you've been in that seat, wherever it may be, and had to wear the risk, and being able to take a problem and a solution and stand by your convictions through the entire process of not just writing a research report, but about research that is risk-based and that is performance-based. And that's the whole, really, the mission of Bear Traps, is create a research product where we have a portfolio, we are measured by our portfolio, just like a hedge fund or an asset manager. And so it's really a research product that is driven by performance and monitored by performance. And the other thing is the Bloomberg chat. So we come up with big theme pieces, which I think are very helpful. Anybody that's watching us right now, Tatiana at the Bear Traps Report, we can email you our piece on commodities, which we came out with a month ago.
It's you spell Tatiana, please?
Yeah, Tatiana.
At Bear Traps Report.
Or if you go to the Bear Traps Report website, support of the Bear Traps Report, that'll get us there too. But that commodity space, that report was written with a real, a number of recommendations, a portfolio view, and the chat. To me, the sell side is in a bad spot right now. That's the banks. Banks, when they produce research, there's no real accountability tied to research. And so we have a Bloomberg chat, as I said earlier, with 500 institutions in it. And it's really a big disruptor for the banks, because the banks can't produce this type of research, because chat rooms for banks, if you're a broker dealer, you have to have an incredibly private situation with your chats. And what we do is we have a chat with 500 people. It's anonymous, so people can't see each other, but we have 50 contributors out of there. We have some family offices. We have a number of portfolio managers that were at big hedge funds that now run family offices or run their own family money, and they contribute and we'll give them our research platform for a big discounted rate, but they contribute. So this is very disruptive to the banks, because it's a product where clients can see research opinions from multiple asset managers anonymously, and at the end of the day, we recap this and then email it to financial advisors, RIAs around the world. So if you're a portfolio manager in Newport Beach, California, or in Zurich, and you want to know what the real institutional traders, portfolio managers were kind of thinking and talking about the previous day, right in the morning, you get that email, and it's like, I think it's one of the most unique innovations in research that we've ever seen, because the problem with being a financial advisor is you have the most incredible quality of life, right? You're not tied to a desk in New York, but you have to be on the road, spending a lot of time with clients. in a pre-COVID world, a post-COVID world. You know, they're playing a lot of golf with clients. They're doing it on ski trips. They're really very social people. And the Bear Traps report really gives them a front row seat as to what the institutions are doing on a daily basis.
That's fantastic. I have to do a close. It takes about 2 minutes, so pardon me, Larry, but we
Sure.
certainly appreciate you being a very special guest on our show today. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles's Effective Family Office podcast, Apple, Spotify, Stitcher, and other channels, in case you were wondering. We also put some of these up on my YouTube channel, which simply is Family Office. And I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great success and their single family offices, doing a significant amount of proprietary content, hosting global events on hold because of COVID, but doing in place of them actively Monday through Friday online meetings for our members in select relationships, doing mastermind groups of families only, and creating actually a whole bunch of intriguing services we're going to roll out this early summer, and has been an incredibly disruptive, in kind of a good way, a time for us. So if you're not a member, feel free to reach out. Our members get special access and opportunities, as well as everything that I noted that certainly is going to be of value to them. I am active on social media, a Family Office on YouTube, Angelo Robles and Family Office Association on LinkedIn, Family Office Association on Instagram. You can reach me at familyofficeassociation.com, our website, and my personal email is angelo@Family Office Association. Everyone, thanks for listening in live. Those that see this on YouTube, thank you so much for watching the video. And those on one of our podcast platforms, we hope you enjoyed it. And of course, a special thank you to our special guest, Larry McDonald. Larry, it's great to see your face again.
Thanks, Angelo. And join me on Twitter @ConvertBond.
You do a great job. Thanks so much. Thank you. Bye.
Thanks, Angelo.